we're going to dive a little deeper into the Yahoo Finance package. That's going to be the focus we're going to have today. Last week we looked at the basic packages that make up this way of doing things. I'm going to call it a system app way, shall we say. But there's the stock screeners, which I recommend FinViz. Then there is the Yahoo Financial Services to do some of your number crunching and technical analysis stuff, what have you. And then there's the internet that is incredibly important, because without the internet we just are dead in the water. And I didn't mention it, but I probably should have. The person sitting in the chair pushing the keyboard and the mouse is the most important part of that system, and I didn't say anything about that up till now. The book Think and Grow Rich was written long before the personal computer era. However, the principles that came out in that book, where you have an idea and you figure out how to put wheels under that idea, that's what we're doing. Without the people doing things, well, if you don't do things, things don't get done. And we can have all these wonderful stock screeners, the Webull.com, free brokers, we can, everything. But without the person to make it happen, nothing happens. So you listening are probably going to end up being one of those people. And again, it's so simple and so easy. So, yahoo.com. I gave the view of the front page, I think it was 2 lessons ago. So, introduction to that. When you click on the finance part of Yahoo, you will then go to the finance homepage, which is second down the line. And there's not much to get excited about on this page. It is, well, you figure it out. You're going to be doing exploring around, and that's not really where the action is. However, on that page, there is, right up in this area, where you will put what you're interested in, the company's name. And this is the most important part right here. In this case, I put in GM. And then I had people go and look, come back. Then we put in General Motors. And we went and we looked. Lo and behold, it was the same thing. Now, back in the old days, before computers, they had what was called ticker symbols. They were up to 4 characters long, and they were basically a shortened version for the company. And GM was for General Motors. Today, with a computer, we can be a little more modern, shall we say, and you can put in the name of the company, and it will go there also. So, when you go to that company's information, it will give you a quick synopsis, and you'll have a chart. And this chart really doesn't do very much for you. It just kind of shows you some information, but Whoopi doesn't tell you anything about that. So you click on this chart, anywhere on the chart, and it will then bring you up to another chart, which is the one that they just throw at you. And it is kind of not very spectacular. And then it gives you all these little tabs here. And when you start exploring through those, you will find all sorts of options for you. And the big ones are that you want to go to the one for the simple moving average. And I forget where it's at. Add indicator, I think that's it. You need to have, okay, if you don't have access to a multitasking computer, just stop the video right now and go to Yahoo Finance and get to the page where you have a simple chart. Click on Add Indicator, because that's the important critical one here. And simple moving average basically says you're going to take a group of numbers, information, you're going to add them all up, take an average. Simple moving average, exactly what it says. The next day, the oldest number will fall off, the new number will be added, and you'll do the whole thing all over again. What we're looking for is the two different trend lines. And I may have given the example how I got excited about this whole process. I was beating my head against a wall for 2.5, 3 years, something like that. I knew that there had to be a simple way that the good old boys back 1930s, 1940s, whatever, could get a handle on what was going on. And this was an inside secret to the boys on Wall Street at the time. I call them the good old boys. Believe me, they didn't tell nobody this little secret. I had to figure it out for myself. And the way it happened was I was sitting one night, it was a Saturday night, 10 o'clock approximately, and I was watching the History Channel. They were talking about, it was an hour-long program, about Lewis and Clark expedition and how they had went to the Pacific and came back from the Pacific. And the tagline on the end of that program was, "Today you can fly over this in a few hours in a commercial airline. If you're in space, it will take you a few minutes to go over this same territory." And I go, oh my God, so easy. And I went to my old laptop, which I still use, and I got into this area right here, and I put in price chart, simple moving average for 30 days, and then a simple moving average for 10 days. I got 2 lines out of it, and it was exactly that secret that the good old boys had back then that they weren't telling anybody. I kind of re-engineered, reinvented the wheel, or back-engineered, reverse-engineered, whatever you want to call it. But it gave me a handle on what they were doing and why they were so successful, because they had been doing the fundamental analysis. Is a company a good company? And comparing it, with other apples in one basket or oranges, whatever. But when it came to the timing, when to get in, when to get out, that was where the technical analysis happened. And there is tons and tons of information. Return on investment charts, moving average convergence divergence charts, stochastics. You can get lost for weeks doing these formulas, trying to figure them out. And if you want to go down that road, Investopedia is an excellent place for you to go. It explains what those formulas are, how to use them, etc. All I'm doing is using the simple moving average on top of a regular price chart. It's that simple. It's a no-brainer. Then going from the line chart, which they give you, which doesn't tell me much, I prefer a candle chart. And that's another one of those indicators that you can find on that top line up here. The candles will be right there, candle. It tells you whether it was a buy day or a sell day, where things entered, it's a little more information than just a line chart. Also down here at the bottom, they have a volume chart, which kind of can be interesting. Now, when you get into that simple moving average part that is so critical, and you open up that simple moving average box here, you will put in 30 days, or the other one that we work with a lot and that I strongly recommend is the one for 10 days. However, get these up so you can see them right. Since you are the operator of your computer, if you want to do 25 days and 7 days, if you want to do 32 days and 12 days, knock yourself out. You get to choose. You get to pick what you want. And it can really be, here's the simple moving average tab that you'll look at occasionally. That's the whole secret to Yahoo Finance, is those indicators and the charts. Once I had this brainstorm, it took me 5 minutes, 10 minutes to go from 0 to having this totally nailed, 100% done. And I was I couldn't believe what I was looking at. And I said, this can't be, it's too simple. Because I expected something more complicated. So I went to Ford, I went to United Airlines, I went to Hawaiian Airlines, all sorts of different companies. And every one of them, it showed me exactly this, when to get in, when to get out. And on this information, since we're talking about it, I will tell you right now what we're going to be looking at here. We have these times when, and I left my chart away. I'm not happy with myself right now. Okay, let's go here and look. This is GM. The price goes down, turns around, and comes up for quite a time. And when it hits the bottom here, a little bit, not at the bottom, but close to it, all of a sudden our trend lines that we're looking at, they also reverse and they start coming up because they're a trailing indicator. It means that the information is fresh on the price chart, but lagging on our trend line chart, trailing it. Anyway, when it starts coming up, that's an indicator then to us that this is something that could be a good thing for us, a good investment. However, this starts up. It starts up in a few other places here. And it doesn't go very far. It turns around and goes the other way again. So just because it's going up doesn't give you a guarantee that it's always going to continue that way for a while. It's simply an indicator that things are getting better. How long they're going to get better, we don't know at the time. So there are 5 things that can happen if you get into an investment at this point. You're either going to make a big money. If it's just a little blip, you're going to make a little bit of money, or you're going to get into it, it's going to go up, and then and you basically go nowhere. It's zero. Big money, zero, little loss, or a big loss. Those are the 5 choices you have. And with protective stops, if it goes up and you're not watching things and there's a flash crash, which occasionally does happen, things could all of a sudden go way down. You don't want that to happen. So you put in a protective, every time you put an order in, put in a protective stop. That's exactly what it means. It's protection for you. Don't go unprotected, is what they say on TV. Well, they're kind of talking about non-financial things there, but here we don't know how far up it's going to go. So we're just speculating at this point. We're riding it up and up and up and up. And somewhere it starts to turn around. Now, you can either look at the chart, and when you get to a point where things turn around, you can see that it's done. You know, this is basically a horizontal process here. It goes up, it goes down, goes up, goes down forever. And sometimes it goes way down, and sometimes it might go way up, but not very often. Anyway, for that particular little run, it'll reach a top, and then it goes down, tries again to go up, then it goes down, blah, blah, blah. Just goes sideways. So, somewhere in here, this is all a sideways sort of thing, our line goes the other way because the price chart is. So, wherever this price, for myself, I say when this line hits the price chart again, I'm out, I'm gone. From down here where I got in to up here where I got out is still a very nice rise. I will never hit the very top simply because the information is lagging type information. However, if you want to watch the actual chart itself, that's your choice. Either way, you're going to make a good profit on your transactions. Now, the book here, this chart here that I used was for Hawaiian Airlines. And it was, I believe, 81 days, which is kind of a little bit longer than a normal swing trade, but not astronomically abnormal. The complete chart kind of goes along, nothing much happening, then it takes off. And where it finally hits up here, it's been going sideways for probably a week, I would guess, 10 days, something like that. But if you have, okay, let me give a little bit of guidance here now. You're going to have your nest egg, what I call it, your bank account with your broker. And I recommend for a beginner that you use maybe 5% of that amount in any given trade. That way, if the trade goes bad, you're not going to lose your basic account. You can recover. If it goes nice on you, that 5% that you have invested will all of a sudden become a bigger amount. And Each individual trade, you can allocate so much of your nest egg to and put it into that trade. I do not recommend that you have more than 5, 6 trades going at any given time. I don't care what they are. Stocks, options, foreign exchange, futures, just keep it simple. Particularly for the first couple of years in your life, till you get a handle on who you are, what you're doing, what your personality is, and your investment style, etc. If you keep looking at, now on this Hawaiian Airlines trade, it was over 80% return on investment. And I don't really like using the percent word. I'll explain that in a minute. But if you get a good return percent on a stock, this is my rule of thumb, to be good, and anything better is better. However, if you can have 5 trades going, you're shooting for that 50% or more return, you're going to have everything just climbing and building and going and doing. And the last lesson, we're going to do a case study, shall we say, that's pretty much what if. It's in the book here. I'm just going to flash this on you right now. Don't get excited about it. We'll get into it much greater then. But in that spreadsheet there, 4.5 years, I think it is, and a person is taking out a big, huge, monster chunk of money before taxes, gross return, every year. And it's an ongoing, never-ending thing. But there's a caveat to that. You have to, every day, be sitting there watching what's going on. Speaking of the importance of you in the chair, working the mouse, working your keyboard, this will take you approximately 5-10 minutes per day just to check, see where you're at, what's happening. And if you decide to get out of a deal at that point, it's usually just a quick click to sell and you're done. At that point, you have made your money and you can go sit down and enjoy yourself for a moment. The real work will come maybe 4 hours during some downtime when you can look at what is the news, what are the FinBiz saying, what are the rumors that you have heard, what does CNBC say, all of this information that you have accumulated. You've taken down notes and scrolled them away, and then you come to your real work time. And there's a lot of people, they will do it at like 1 o'clock Sunday morning or something when the markets are closed, things are dead, nothing's happening, and you can really do your fundamental analysis to see whether or not these are good companies to even think about. How do they compare to other companies? Do you want to get involved with them? Myself, personally, I will not, and I mean I will not, get involved in any cannabis companies. I tend to 99.9% of the time run away from all pharmaceutical companies, and I tend to have a dislike for coal and oil industries. That's just my own personal preference. But by eliminating certain categories, there's a technical word for it, well, an official word for it, not technical. Technical is usually associated with analysis, but the official thing is sectors and categories. There's I think, a few categories, and then there's altogether maybe 150, 200 sectors or something like that. And these sectors and categories and so forth, they will some be going down and others be going up. Retail marketing usually is a good rising sector in the fall because everybody's getting ready for Christmas sales. Then January, February, March, retail industries are having their clearance sales, and you don't want to be involved in retail sales in the early part of the year. It's not good. So you'll learn these things, and with the information you find on the blogs, on CNBC, a lot of it is historical or stuff that is current, but is real quickly becoming old. What's the Federal Reserve Board doing? Are they raising interest rates? Are they cutting interest rates? That then leads into what's the political thing that's happening? Are we talking about maybe some tax legislation? It can get all sorts of things happening. I talked about flash crashes. When the 9/11 event happened, there were people that were in the market and they did not have any protective stops. The markets did a nosedive, particularly the airline industries, and a lot of people lost a bunch of money. And that is not good for an investor. So, again, anytime that you have an order in to be executed, along with it should go a protective stop. And your broker will tell you how to structure that, what the sequence of characters should be, and so forth. Occasionally, there is also the reverse of that, where you have spikes in an upward fashion. These are usually what I call calendar news events. Periodically, and it's on everybody's calendar, they know the unemployment numbers are going to come out, the retail numbers are going to come out, the construction numbers are going to come out. And based on these numbers, whether they are really good or depressed, occasionally when they're really good and you are not supposed to know about it ahead of time, but if you hunt around and watch the options for, say, the construction, you know that some of the home builders, you watch their option business, you might see their options go up and you think, oh, this is going to be a good deal coming here. There's going to be good information. So you might want to expect Kaufman and Broad to all of a sudden have a better future. Well, the news will come out and all of a sudden their stocks in a matter of minutes will jump. And it might not be much, just $1 or $2 in their $50 chart, but that little $2 jump, if you can get in, do your thing, and 3 hours later get out, $2 for that short a period of time, that's a nice amount. By the way, when I mention these, I'm going to talk this much later in another lesson, wrapping things up. We're talking price charts for a single share right now. Be aware that when you get rolling, now when you first start, you're going to be buying $20, $50 sort of investments. And that's good. That's normal. That's what you should be doing at your beginning stages. When you get really rolling though, you're going to be chunking in well, in the financial world, they call it a block of stock. It's 100 shares. And you're going to be buying 100 shares at $50 a pop for each share. That's what, $5,000? So you're going to be working with some bigger numbers. Well, when you get 100 shares and you get, on that construction example, a $2 jump and you get out, that's $200 you just made in a few minutes. That's enough to buy a hamburger and a tank of gas easily. So right now, we're talking single shares, and be aware of that. In one of the earlier lessons, I think it was last lesson, I talked about ETF. I went to the computer and I looked this up, a list of ETFs. And there are a bunch of them, and it's getting bigger all the time. If you want one on gold mines, it's here. If you want one on ski manufacturers, it's here. If you want one on motorcycles, it's here. All of the exchange-traded funds, they're a bunch of industries, common sectors, common everything, market to whoever. Those ETFs are treated just exactly like a stock, but think of it really as a mutual fund. You buy into it, you own it, and you can watch it go up and down. If you want to go the next step, you can easily look into each one of those ETFs and you can find which one of those stocks is the best stock, which one's the worst. I do not recommend for anybody in the first year, maybe even 2 years, to even think about selling short. But if you start looking into these ETFs down the road and you find one that's really not doing very good, you might seriously want to think about shorting it. Indian Motorcycles was bought by was a ski mobile manufacturer. One's a summer industry, one's a winter industry, and they were both small, motorized adult toy appliances sort of thing. And the thinking was they were going to offset one season with the other season, have everybody keep working and do their thing. Indian Motorcycle was one of the motorcycles that's an old company, old name, and technically or officially they're one of the nicer motorcycles, I think. But the quality wasn't there, I think was one of the things I heard. Anyway, everybody was bad-mouthing them, and they had some problems with their speedometer. They couldn't work on them, and because of lemon laws, things like that. So anyway, last I heard, Indian Motorcycles were hanging on by a fingernail. They may have already gone down for all I know. But if you knew something, you were a motorcycle person, motorcycle rider, you could invest a little bit maybe. But this gets into another area now, the emotions that you have regarding whether or not to invest and so forth. I really, really, really hit on this topic really hard in this little book. If you have any feelings at all, that should be an indicator of how much you should not be involved in that company. If you're really in love with it, then run away from it equally fast. When I was young and dumb, I was all of 19 years old, no, 18 years old. I worked for Zenith Radio Corporation. They're gone. They got rolled into Sony a long time ago. But every day I looked at what was their price. They were listed in the newspapers then. Today, you can't find it in a newspaper. Maybe the Wall Street Journal might say something, or one of the big financial papers, but most of the time you have to go on the internet to find out a price number now. Anyway, every day I looked at these numbers. I wanted to see what my company was doing. And I didn't have any money to invest. I was hand-to-mouth living, just getting my life started. And if I would have invested, I would have been the most green and dumb investor on the face of the earth. I didn't know who the board members were. I didn't know what markets they had that were not exactly advertised, such as military or such as the covert CIA type markets. All I knew was they were consumer electronics, and I was working for them, and I wanted to know what my company was doing. Because of my sentiments, don't ever get into something you love. You have to be stone cold, hard, logical about this. And if the numbers aren't there, get out of it. If the numbers are there, get into it. But that brings up another little topic, record keeping for yourself. When you are looking at your chart with all these wonderful lines on it, and you make a decision to invest, what I do is I real quick run a copy of what is on the screen. You can find instructions on how to print out what you are looking at, capture and print. And then on the back of that, you're going to have 6, 9 little fundamental analysis numbers. And that will give you a start point of when you get into it. When you exit this deal, same thing. Run yourself a price chart, and this time on the back of it, instead of doing the fundamental analysis stuff, put down how much did you make, how long were you in it, what was your return, your percentage of return, whatever. You want to be able to keep a record for anybody, IRS, yourself, be able to have conflicts with your broker about, hey, my account should have, da-da-da-da-da. And then you start arguing about brokerage fees and stuff like that. Oh, that brings up another point, brokerage fees. Webull.com. Can't be positive enough about these people. They're in New York, which is a good thing because they are right sitting on top of the fiber optic lines, and the information they have is very current. They have all of these things that they do. And I may have mentioned last time that the transactions that they do, if you can do it with a computer so there's nobody involved, Webull will do it for free going in and free going out. If you get involved with a broker there, selling short, doing some oddball thing, investing in an offshore company, then they'll quote you what their fees are going to be. And let's see, I got so many things I want to talk about here. I made myself some notes, and I think I've talked just about all of these. Told you to stay away from the, oh, yes. This is a poster child of a penny stock. And if you want to look it up, QMCQF is the ticker number. It's Quantum Minerals of Manitoba, Canada. And They are a poster child of what a penny stock is, and a poster child for why not to get involved. They have very minimal operations. They're usually out of the country. The brokerage fees are higher than the sky, usually. And I would refer you again to the movie Wolf of Wall Street. And when it comes time to sell your penny stock, you're going to be lucky if you can find anybody that will even talk to you. This particular penny stock here is for rare earths that are in very short supply right now. And the mine found these back in the 50s, has been dormant, and now they're trying to generate funds to start their mine again. If you go into some of these sort of things, because of the small startup aspects of it, and the fact that you can't find anybody to buy your shares, you better plan on sitting on these for a long time. I'm talking 20, 30 years, and then maybe having to write them off. I throw that out to you to give you an idea of penny stocks and why I don't get too excited about them. We are going to go into a case study of Hawaiian Airlines on the next one, which is what this chart is all about. And it's going to be also then the follow-on part of that, of where we are going to make our future with our activities. Thank you very much.